Hey everybody, happy Friday. I am shooting this video from the great city of Cincinnati. I stayed at my Airbnb down here in Walnut Hills last night after doing a happy hour over in Covington, Kentucky with a lot of people that I've known for a long time and doing business for a long time. We just had an absolute blast. What I want to talk to you guys about today is, at UHM we have a lot of very experienced loan officers, and we know that having a conventional financing can be the difference between getting an offer accepted or not in today's market. But here's a few reasons why your client is pre-approved for an FHA loan and not a conventional loan. So first of all, let's cover what the basic qualifications, three main criteria for qualifying for a mortgage. One is your credit score, two is your source of down payment, and three is your debt to income ratio. So it is a balancing act of analyzing that information in order to qualify somebody appropriately for a mortgage during the pre-approval process. So with FHA, it is going to be the most lenient program. It is the hands down the easiest to qualify for. You could be relatively weak in all three categories and still qualify for an FHA mortgage, while conventional, you generally got to be strong in at least one, if not two of those categories in order to qualify for that type of financing. So going with an FHA loan versus conventional could be the deciding factor of getting approved or not. And some clients, they don't even have the option. They just can only go FHA based on their current circumstances. The next thing is the interest rate. So not everybody knows this, but FHA can have much more competitive interest rates than conventional, especially for those clients who have a sub 700 credit score. FHA is really going to start to separate and have a much better interest rate compared to conventional. Once you get below 700 credit score, conventional can start to get very pricey very quickly. The next thing is the down payment. We all know that with FHA, a 3.5% down payment is the minimum requirement. However, I've had situations where buyers have a very low credit score and a very high debt to income ratio, and they do not get qualified with a 3.5% down payment because that's the bare minimum. So we bump it up to 5, 10, or even 20% in order to qualify for them. And if the borrower has the funds, that could be the difference between them getting a mortgage or just not getting pre-approved whatsoever. So the next item is the actual debt to income ratio. With conventional, generally you're up to 50%, and that is the limit. However, if you have a lower credit score for conventional or you have a minimal down payment, you may only get qualified up to 43% or even below that. With FHA, it's a lot easier to get qualified at a higher debt to income ratio, and it actually goes all the way up to 55%, and that can make a big difference in the qualifications and the limit that the borrower actually qualifies for. The next thing is the PMI, or with FHA it's called MIP, aka mortgage insurance premium. And with FHA, you have an upfront mortgage insurance premium that's financed into the loan, and you have a monthly mortgage insurance premium as well. So with FHA, it does not matter what level of down payment you put, you're always going to have both forms of mortgage insurance. Now, when you have less than a 10% down payment, that mortgage insurance is going to stay on, that monthly mortgage insurance is going to stay on the loan for the life of the loan unless you refinance into a conventional mortgage. If you put over a 10% down payment, then it will stay on there for 11 years. But in reality, we're most likely refinancing FHA loans after a couple years into a conventional loan. So those are some tips about FHA loans and why they can be beneficial for a client. Another reason why is the reserve. So I've put in loans and did not get automated approval with zero reserves on an FHA loan, again because maybe they minimal down payment, high debt to income ratio, lower credit score. But by documenting and plugging in 1 to 2 months of reserves, that's the difference of what got them approved for that mortgage. So it's that level of detail and commitment to the process, and the knowing and the knowledge and the advisory of doing all of that due diligence up front during the pre-approval and really pinning down those details is like the difference between a bad loan process when you're in contract already and a great loan process, or a loan getting denied when it goes into underwriting versus a loan getting approved every single time. So if you have any clients out there that need to get a second opinion on their pre-approval, send them my way. I'd be happy to assess their situation this weekend. Otherwise, have a great rest of your day. Talk soon.